I think the three main risks for an investor are very much what they probably have been for the last few years. First and foremost, interest rates are going to go up, and investors just need to be cognizant that we're in a very favourable environment, and they need to think about the economics of their investment strategy with a higher interest rate level. So, once they look at their net income and their debt costs on a more normalised interest rate level, is there still healthy cash flow? Are they in a surplus or are they in a deficit? And I think that we need to continue to look at that. And whilst the market has flattened and the expectation of interest rate rises has gone out further than it probably had done if we'd had this conversation 6 months ago, they're going to go up. So think about it in those terms and make sure it's sustainable. Your portfolio is sustainable when they do. Secondly, tenant affordability. And the whole point here is income versus property values, whether that be in the owner-occupied market or in the investment market. Because history teaches us when incomes become unaligned or detached from values is when we tend to get bubbles and sharp corrections. And whilst rental growth is strong, we look at the amount of disposable income that tenants are using to pay for their rent, in regions 40, 50, 55% in London. I just think we need to be a little bit cognizant that rents need to be paid, they need to get paid out of income. So we just need to be conscious that tenants can still afford the rents, and the rent appreciation forecast of 20% for the next 4 or 5 years are great to hear, but I think investors just need to make sure that they're sensible with the rent levels that they're going to be getting vis-a-vis incomes for tenants. And then the third message is gearing, and I come back to this quite regularly. The highly leveraged investor is the one that's least able to withstand shocks, which will happen. They can be shocks just bespoke to their portfolio, unintended repairs, difficult tenants. They could be economic shocks around property prices or interest rates. Either way, if you're heavily geared, you have less ability to withstand those. And that's a trade-off with growth, because the higher you gear, the faster you can grow, but the kind of more risk you take. So just being sensible about the level of gearing in a portfolio, I think is the most important thing for an investor to keep asking themselves about.